A very, very good evening to all the attendees who have gathered today to hear to our Stay Tuned webinar on COVID-19 and financial markets. McGraw-Hill welcomes you to the webinar. Today we have with us Professor Anshul Jain from MDI Gurgaon. He's a faculty in accounting and finance. He's an alumnus of IIT Delhi and IIM Lucknow. Today, this webinar will explore the behavior of financial markets and government response in the past 6 months of COVID-19. Our speaker has written and published many research and newspaper articles on the subject of financial markets, along with teaching cases. McGraw-Hill has recently published a book co-authored by him titled Financial Markets and Institutions, which is also available on your screens. He has also been published in very renowned journals, including Applied Economics, Resources Policy, Journal of Multinational Financial Management, and International Journal of Financial Markets and Derivatives. Over to you, sir. All the best. Thank you.
Thank you, Prakriti, and thank you, McGraw-Hill, for organizing this seminar. I would again like to welcome everyone for taking time out to come and listen to me on the webinar titled COVID-19 and Financial Markets. Before I start on the relation between COVID-19 and how financial markets have behaved in the last 6 months, I would like to emphasize that financial markets and the real economy are symbiotic to each other. At times, the economy might be doing poorly, whereas some financial markets might seem to be doing well, and at times the reverse might be true. Let me start with an example. If I look at 2008-2009 crisis, the financial market, which you all watch, which is the stock market, collapsed in India, but the underlying real economy did not suffer. Compare this to the US, where both the underlying real economy as well as the stock market collapsed. In case of COVID-19, what has happened is that governments over the world have tried to avoid a repeat of 2008-2009. Governments have realized that a crisis in the financial market hurts the real economy in the longer run, and so a crisis has to be avoided in the financial markets at all costs. Now, before getting into markets, let me just highlight the timeline of COVID-19 and why we call it 19. The WHO's first report on COVID-19 came out on 8th December 2019 when they highlighted the first symptoms. In January, the last week of January, human-to-human transmission was confirmed by WHO and China. 23rd January, Wuhan went into lockdown. 30th January, instead of declaring a pandemic, WHO declared a public health emergency of international concern, and we in India also saw our first case. 11th March, WHO declared COVID-19 a pandemic. This is the point at which panic started to set in financial markets, and we'll talk about this as we move along. And on 24th March, we ourselves had the initiation of our lockdown, which finally ended on 31st May 2020. Since then, we have been having different stages of unlock happening in our economy. Now, coming to the financial market, which all of us love to watch, which is the stock market. In this slide, I have tried to compare how the US S&P 500 and the Nifty in India have behaved for this current calendar year. So if you look at these two, the blue line represents the S&P, the orange line represents the Nifty. On the left axis, we have the index numbers for S&P. On the right axis, we have the index numbers for Nifty. Now, whenever we are comparing two markets, it makes a lot of sense, instead of comparing the levels, to compare their returns based to a certain date. If I start from 1st January 2020 for the current calendar year, and if I look at returns from that day, what is very clearly visible that since March, in the month of March, starting March, the market started declining sharply, and they touched bottom by the end of March. Thinking back to the timeline, this is the time, 24th March, when lockdown was initiated. This is the period during which the pandemic was declared. This is the period of actual panic. Luckily, this time, unlike 2008-2009, governments and regulators very, very quickly jumped into action. In fact, if you look at this graph, it is very clear that markets touched their bottom by the end of March. And since March, the markets have been very sharply recovering. In fact, if you look at this and you compare what has been the movement of markets over the entire year, the S&P 500 is actually touching new highs, whereas the Nifty is only down by about 5 to 10% from the year beginning numbers. Now, this is where the disconnect between financial markets and the real economy should become very apparent to you. From a financial market point of view, if you talk about the stock market and you see that the Nifty is down only 5 to 10% for the year, you would believe that everything is well in the underlying economy. But in reality, we all know that the underlying economy is going through a sharp contraction. The first quarter of this financial year saw the worst contraction since independence. And this is where a lot of people also wonder, why is the market at an all-time high and the economy is doing so poorly? The answer to that in the case of stock markets is very simple. If I look at the Nifty 50, it's only a collection of 50 large companies. These companies are the ones which are relatively insulated from the pandemic for the simple reason that they're able to access funding very, very easily. Many of these large companies, in fact, have gone in for fundraising during this pandemic. And the actions of various regulators and the government has actually helped them in raising funds. So the future of these 50 companies is not as dim as probably the rest of the market. Even in the 50 companies in Nifty, a couple of companies are doing exceptionally well, and we all have been following Reliance. If I look at Reliance, they have raised a significant amount of funds for Geo. Recently, they have acquired Future Retail also. And so, because Reliance is one of the major heavyweights in the Nifty 50 index, it's actually pulling the index along with itself. And that's why, even though the market is only down by 5 to 10%, it does not really reflect what is happening in the underlying real economy. The second reason is that the simplest model for calculation of stock prices, which is a dividend discount model, has two components. It has dividends in the numerator and the difference of cost of equity and growth in the denominator. Now, if I look at cost of equity and growth, the recent fall in government yields and the risk-free rate has pulled down both the cost of equity, and growth has come down because of the pandemic. So the difference between cost of equity and growth has not changed by much or has even reduced. So even if dividends have reduced by a little bit, the reduction in the difference between cost of equity and growth has allowed markets to jump up and reclaim most of their losses. A third reason why markets have seemed to bounce back so sharply is a lack of alternative investment opportunities. Suppose if I were to invest in an FD today, I would hardly get anywhere around 5%. Whereas even 6 months back, the rates were somewhere around 6.5%. Couple of years back, the rates were around 8%. This has pushed more and more people into market assets. Brokers in India have seen more and more retail investors opening brokerage accounts and participating in these stock markets. All of these reasons contribute to the market having recovered most of its losses. But as I have said, there is a sharp disconnect between the market and the real economy, and we cannot really use this index as an indicator of what is happening on the ground in the real economy. Coming to the next slide, if you look at the next slide, it talks about the intraday movement in S&P 500 and Nifty since the beginning of this year. Now, why am I talking about intraday movement? The intraday movement reflects the amount of panic in the market. It reflects the uncertainty in the market. It reflects that what sort of sharp entries and sharp exits are happening in the market. If you look at this, usually the intraday movement seems to be somewhere below or between 2 to 3% range pre-pandemic. If you look at January to February and February to March, the intraday movement of markets, the ratio of high to low, is about 2%. In March, this started going up, reaching almost 18% nearing the lockdown. This indicates a significant amount of lack of liquidity and panic in the markets. This lack of liquidity is an indicator of crisis. Lack of liquidity essentially means that there are not sufficient buyers and there are insufficient sellers in the market. People are unwilling to trade in the market because people are afraid. People are not sure what is the appropriate price at which I should buy and what is the appropriate price at which I should sell. This causes a lot of intraday movement in the stock market, and this is very clearly visible that by the time the lockdown came into effect, the intraday movement or the panic in the market had reached an exceptionally high level. And what you can also observe from this graph is that it started to come down rapidly as May approached, and the economy was again opened up post May. And you can see the intraday movements are slowly, steadily coming down below 4%. And in August, most of the intraday movements have been below 2%. So, as I mentioned earlier, the crisis in the market happened in the pre-lockdown period. It happened mostly in March when the pandemic was announced and lockdowns were still to be announced, because there was a lot of uncertainty as to the government response. There was an uncertainty whether governments will step in and help markets and help the real economy. And governments and regulators, when they stepped in once the lockdown was initiated, markets started coming down and uncertainty reduced. And this is indicative in the intraday movement also coming down. Next, if you look at the implied volatilities in the market, so this is a chart which shows you India VIX. India VIX is the India Volatility Index. The volatility index is computed from the prices of Nifty options which are trading on the exchange, and what it tries to indicate is the expectation of the market regarding volatility in the upcoming 30 calendar days. Let me repeat this. So the India Volatility Index is computed using Nifty option prices on the NSE, and it gives us an indication of what market participants are thinking about upcoming volatility in the next 30 days. As is expected, pre-March, this number was below 20%. Typically, the India VIX in periods of calm, when there is no panic, moves between 10 to 20%. This has been the recent behavior of the India VIX, and we can see that in the January and February periods, in the first 2 months of this year. But in the month of March, as the reality of the pandemic started dawning on investors, the India VIX also jumped sharply up, peaking up just before the beginning of April. And since April, we have seen the India VIX slowly, steadily coming down. And recently, it has again touched the 20% number, which very indicates to us that it's coming back into the normal zone. Again, let me re-emphasize, the crisis period was in March because investors were uncertain, investors were not sure whether or not the governments will be able to react in time with enough firepower to support the real economy and to support the markets. Because the experience of 2008 and 9 and the delay in action which was there in 2008 and 9 spooked investors. Investors felt that because of a pandemic, the real economy is going to crash, the governments will be again late, the regulators will be again late, and so there was a lot of panic. Once the lockdown was initiated, this panic subsided, and we can see that now even India VIX, which is the indicator of upcoming volatility, is coming back into its normal zone of 10 to 20%. Then, if we move and talk about liquidity in the markets. Liquidity in the market essentially means that what is the amount of trade which is happening in the markets. Because trade indicates willingness to participate. Trade indicates that investors are coming in with cash and buying stocks. Investors are coming in with stocks and selling stocks, and they are comfortable buying and selling and interacting at those particular price levels. Now, if you look at this, again, in the pre-March period versus the March period, there is a sharp spike in trade volume towards the end of March. This is the time at which a lot of investors exited from the market as they were uncertain as to what will be the response of the Indian government towards this pandemic. At that point of time, because it was not very clear what will be the true impact of the pandemic, how many people will be infected, what will be the fatalities, given the size of India and the lack of healthcare, all this contributed to the panic. And you can see that the trading volume became almost 3 times the pre-March trading volumes. So I hope you can see that pre-March trading volumes were around 2,000 crores per day, whereas during the last week of March, this touched almost 6,000 crores on a particular day. This indicates that investors were trying to exit as quickly as possible. Why am I saying that we can see investors trying to exit? Because I'm now putting together two different slides. I'm talking about the initial slides which showed that towards the end of March the markets collapsed, and this slide shows the high volumes. This indicates that a lot of investors were dumping a large amount of stock in the markets just to exit from the market. A very common analogy which I use in my classroom to discuss this is, imagine that if an elephant has been enclosed in this room with me and the elephant goes mad, what will happen? The elephant will destroy the room, and the elephant, in its madness to get out of the room, will also destroy the door. This is what happens, especially in Indian markets, when foreign investors are spooked and foreign investors want to exit. In their hurry to exit, they are willing to dump the stocks at whatever price is available to them. That creates a high volume. That dumping of stocks forces the market to fall, which allows them to give an exit. Right? So FIIs, always remember, are like a huge elephant in the room. And when FIIs exit, the market trembles. Coming to the next slide, just one thing which I wanted to highlight. During the lockdown period, the volumes in the markets again tempered. They were higher than previous volumes, but they were not as high as 6,000 crores. And once the lockdown was lifted, volumes again jumped, and we'll talk about why these volumes jumped in the next slide. Now, this is a very interesting slide because this tells us how did foreign institutional investors behave and how did domestic institutional investors behave in this calendar year. The blue line represents the net purchases for foreign institutional investors, or the FIIs, whereas the orange line indicates the net purchases for the domestic institutional investors. Notice that in the month of March, the net purchases of FIIs became negative, and negative to the tune of 5,000 crores. That means foreign institutional investors were regularly dumping stocks worth 5,000 crores on a daily basis. Luckily, DIIs were also in the market. They were purchasing a lot of stocks. You can see a direct opposite behavior. Domestic institutions were buying the stocks, foreign institutions were dumping the stock, and this led to the large volumes which we have seen in the previous slide. Right? So in the period of March, what you can understand is that foreign institutions are dumping stocks and domestic institutions are buying stock. But because the ferocity of selling by foreign institutions is very high, it's like an elephant trying to exit a room, that caused the market to fall. Now, if I look at what has happened post unlock, if you look at this large blue spike and if you look at the other blue spikes, so there are three very large blue spikes which are very clearly visible. This indicates a large amount of foreign capital flowing back into the country in the stock markets. Essentially, there were some foreign institutions which, once the unlock opened up, realized that markets are at a steep discount, and that at this discount, along with the steps taken by the government, the markets will do well in the longer run, and that's why they were very happy to enter into the markets. Notice at this point of time, domestic institutional investors were still not heavy sellers. They were still buyers. That is indicated that most of the orange line is still near or above zero. But FIIs were sharp buyers, especially at three different instances. Let me come back to the initial slide on returns and correlate all of this for you. Now I think the story would become very clear. In the month of March, you can very clearly see the markets sharply nosedive, both the S&P as well as Nifty, because globally investors were spooked. They were not sure how governments will react. They were not sure what firepower governments have in controlling this pandemic. They were not sure what is the total transmission rate, the number of people who will be infected, the fatality rate. There were talks of hospitals getting overrun. This all happened in March. Investors got spooked, investors exited the markets. As a lot of investors in Indian markets are foreign investors and they took a very sharp exit, our markets fell sharply much more as compared to the S&P 500. Post unlock, post the period of May and June, you can look at this period of May and June, we have seen what looks like an almost sharp bull run, because the market has gained almost 25% from that level of early June. This is the period when FII started coming back into the markets, DIIs held on and kept on buying stocks slowly, steadily, and this is what has helped us to recover most of the losses for this current calendar year. Another word of warning, again the same thing, markets are somewhat disconnected from the underlying economy because Nifty 50 stocks are ultra large capital companies. They have no problems in raising funds. All of them went ahead and raised funds in one way or another. In fact, when the smaller companies suffer, these 50 are the large ones which will do very, very well. Now, moving ahead from stock markets, everyone loves to talk about stock markets because whichever news channel you open, it always shows you stock markets. But there is a much more important market which we don't appreciate as much, which is the market for government bonds and government securities. Now, this slide shows you what is known in the finance world as the repo reverse repo corridor. Now, what is the repo rate and what is the reverse repo rate? The repo rate is the rate at which banks can borrow from the RBI, and the reverse repo rate is the rate at which banks can lend or place a deposit at the RBI. So what usually happens is that the RBI holds these two rates about 25 basis points apart. That is 0.25% apart. So you can see in the pre-lockdown period up till March end, the difference between these two rates was about 25 basis points or 0.25%. Usually the 3-month treasury bill yield moves between these two. Why? Because banks are happier buying the 3-month treasury bill and the rate remains between repo and the reverse repo, because reverse repo offers a floor. I can go and deposit money at the RBI at the reverse repo, and I can go and borrow money from the RBI at the repo. And so the 3-month treasury bill usually moves between these two in periods when the market is not in panic, which we can see in the pre-March portion. Post the panic in the market, you can look at the period of March. The 3-month treasury bill started falling below the reverse repo rate. That means markets were willing, or banks and financial institutions were willing to buy 3-month government treasury bills, even though the RBI was willing to offer them a higher rate of return at the reverse repo. And the reason for this is very simple. The RBI reverse repo rate is an overnight rate. The banks can park money with the RBI at the reverse repo rate overnight for a period of 1 day. But I can buy a 3-month bill and hold it for the next 3 months. So even if I am buying the bill at a rate less than the reverse repo rate, I will get that particular rate for the next 3 months. Whereas if I invest at the reverse repo rate, that is only an overnight rate. So what does this tell us? This tells us that whenever the 3-month rate falls below the reverse repo rate, the banks and other institutions are very fearful that the RBI is going to go ahead with the rate cut. The RBI, as soon as it does a rate cut, the reverse repo and repo rates are going to come down and banks are going to earn a lower return on their balances which they hold with the RBI. Now, if you look at what has happened during the first rate cut, the 3-month yields came very close to the reverse repo rate, but in the period of May and June, when banks and institutions realized that the real economy was in the doldrums, they were investing heavily in 3-month treasury bills at rates consistently below the reverse repo rate. This sort of behavior indicates that banks and financial institutions believe that the repo and the reverse repo are going to come even further down, that further rate cuts are coming. For the simple reason they are able to understand that the economy is not doing well and a rate cut would be necessary to spur growth back into the economy. Right? Now notice one thing, the gap between the orange and the blue line. So orange is the repo, blue is the reverse repo. Earlier it was 25 basis points, now it is almost 65 basis points. It is 65 basis points. That gap has increased. The RBI, in a way, is telling banks, do not keep any amount of money with me. Whatever excess capital you have, lend it out, because I will give you a very, very poor rate of return. But look at what banks are doing. Banks are happier accepting an even lower rate of return because they are fearful of further rate cuts coming down the line. And this has been a source of concern for the RBI, because if you've been following the news, you would realize that the Monetary Policy Committee has not gone in for a rate cut at the last meeting. Inflation in India is hovering near the 6% mark, and by law, the MPC has to increase rates if inflation crosses 6%. Now understand the conundrum in which the RBI is. You have an economy where in the real economy it's visible that growth has become negative. Growth is there is absolutely a degrowth and a depression sort of situation. But inflation is consistently high at about 6%. Inflation says the RBI should increase rates. Lack of growth and degrowth says the RBI should reduce rate. This has also put RBI into some bit of a paralysis. RBI is not very clear on what they should do. So Shaktikant Das has repeatedly threatened the markets. I have many more tools in my basket. Rates are not the only tools. Please behave. But the markets have not listened to Shaktikant Das. Markets have said that we are still going to keep about 5 lakh crores at the reverse repo rate with the RBI overnight, day after day after day. Just imagine, if you look at the RBI package, there are various estimates for what RBI's package is. Some say it's around 8 lakh crores, some say it's around 9 lakh crores, but 5 lakh crores of liquidity has been returned to the RBI by banks and kept at the low rate of 3.4%. Just imagine. Now, if you look at other government rates in the economy, you will be further surprised. So just as a benchmark, I have included in this slide the repo rate as blue and the India 3-month T-bill rate as orange. These are the two variables we were talking about in the previous slide. The other three variables over here, the blue one, the dark blue one is the India 30-year government bond rate, the yellow one is the 10-year bond rate, and the grey one is the 3-year bond rate. Notice that despite several rounds of rate cut, despite the 3-month yields coming down, the 30-year rate and the 10-year rate are very, very sticky. They have not moved down as expected. That means the market is telling the government, if you want to borrow for the short term, we are very happy to lend you at a very low rate. But if you want to borrow for the longer term, we believe that you still need to pay us a much more higher rate. Now, put yourself in the shoes of Nirmala Sitharaman and understand the implication. So, if I want to borrow to spend for COVID relief, I have to return that money within 3 months. If the economy does not recover in 3 months and my tax collection does not recover in 3 months, how am I going to repay that? So I would like to take a longer term loan. I would like to take, say, a 5 or 10 or even a 30-year loan from the markets. But the markets are saying, if you take a longer term loan from us, you also have to pay a significantly higher rate of interest. This is another problem which both the government and the RBI is facing, that short term rates have moved very quickly along with the repo rate, and they have literally crashed. But long term rates, the rates at which the government wants to borrow, have remained very sticky and are very, very high even today. In fact, what we call as the yield curve has steepened significantly. So when we come to the next slide, what you will see is that this is what we call as a yield curve. I have taken 4 different interest rates, which is the 3-month rate, the 3-year rate, the 10-year rate, and the 30-year rate. So the line at the top is the yield curve on the beginning of this year on 1st January 2020, and you can see that the steepness of that line as compared to the line at the bottom, which was there on the 1st of July, is very different. The line, which is the light blue line, 1st of July, is very, very steep. That means short-term rates have crashed, long-term rates have not moved by as much. You can very clearly see short-term rates have moved from 5% to almost 3%, whereas long-term rates have only moved from 7% to about 6.5%. Even though the government would be happy to borrow long-term because it needs time to repay the money which it borrows from the markets are not allowing that to happen. Because the markets say there is consistent inflation in the Indian economy, which has a risk of getting out of control. The RBI seems to be out of firepower, and so we are not going to lend to the government for the longer term at a lower rate. We are going to charge a higher rate. And again, this is a huge point of concern for Nirmala Sitharaman and Shaktikant Das. Now, if we look at term spreads, term spreads is slightly more technical, but let me try and explain this to you. Term spread talks about what is the difference between, say, a longer term rate and a shorter term rate. Now, if you look at this, the blue line talks about the 3-year, 3-month term spread. If you look at this, when the pandemic started in March and the lockdown was imposed, these spreads were at their bottom. So you can see that both the orange and the blue were in a lower zone in the initial portion of the year and especially during March. But since March, all these spreads have gone up, which is something which is also reflected in the prior yield curves which we have seen. When the term spreads increase, it essentially says that all the investors in the market feel that an inflationary situation is going to happen in the economy in the longer run. And just imagine a degrowth situation with inflation is going to be very, very tough for the government to manage. Now, let me reiterate one more thing. The bond markets and the real economies are much more in sync as compared to the stock market and the real economy. Because the bond market talks about a real variable, which is the interest rate at which the government borrows. And government reaction to the pandemic is controlled by interest rates to a large extent. Whereas the stock market talks about, especially in India and Nifty 50, it talks about the 50 largest corporations, which are ultra large caps and protected from the effects of the pandemic to a certain extent. Now, again, coming to the volumes in the markets, just to illustrate the sort of panic which was there in the markets, look at the volumes in the period of March, and you can again see the familiar spike which you also saw in the stock markets. So this slide talks about the government securities trading volume at Clearing Corporation of India Limited, and the spike in the month of March and the high volumes in the month of March are clearly visible. Also notice that in the month of April, trading volumes in government securities crashed to almost all-time lows. The reason for that is the same, that there was a lot of uncertainty even in the month of April as to how will interest rates look like in the future. It is only when the RBI cut rates a number of times and Shaktikant Das came and reassured markets that trading volume again picked up. Another reason was that many brokers and stock market participants found it very easily to work from home. But most of the trading in the government securities markets happens at the locations of banks and other large financial institutions via very secure systems because the volumes are so much more larger. So if you look at the numbers, these are all in crores, and you can see they're huge numbers as compared to the stock market. Due to the large transaction size, due to the specialized systems and the secure systems which are used, it was very difficult for these traders to work from home, and that was another contributing factor as to the reason why the volumes crashed in this market. But the volumes have mostly recovered. You can see that in the months of June, July, and August, the volumes look almost exactly as they did in the months of January and February. Next, we come and talk about the currency market. And the currency market is important to us because a significant bit of inflation, which we used to see in India, was imported inflation. Imported inflation happens because of crude oil. India is dependent on crude imports. Uh, our internal production is very low, and so whenever the rupee depreciates, it automatically increases the price of crude in our local currency terms, the rupee, and that leads to inflation in India. And so the spike in the currency or the sharp depreciation in the currency from the 71 72 levels to 76 again in the month of March was a source of panic for the markets. It led people to believe that there will be extremely high inflation going ahead and petrol diesel prices will spike in India. Luckily, the currency stabilized at the 76 level. RBI took a lot of steps, and we'll talk about those steps, what happened. And now, slowly, steadily, we also see that the currency is recovering and has come back to the 74, 73 range. One very interesting thing that the RBI has said is that it will now also use the currency as an inflationary management tool. That means it's telling the market that interest rates are not the only weapon in my bucket. I am also going to manage the currency to control inflation. And this statement came only yesterday. It's a very interesting new paradigm which the RBI is getting into because it's trying to threaten the market. It's trying to tell the market that we will control inflation no matter what. And so long-term rates should come down. Luckily, the crude basket of India, which is essentially a mix of Dubai crude prices and a bit of Brent prices, also collapsed when demand collapsed. So you can see that beginning of the year, when the pandemic started in China, crude started falling from January itself because the crude markets realized that China, being a major consumer of crude, its consumption is going to come down. And so the decline in crude market started in January itself, and it came down to its bottom during the lockdown. And once the lockdown eased off, once India also started opening up and globally unlock started, you can see it has again come back and stabilized at a low level. So the entire fear of imported inflation in this current scenario was just that. It was just a panic and a fear because even though the currency has depreciated significantly, easing of crude price basket for India allowed control of inflation. In fact, a significant source of inflation in India is food prices. And food prices is controlled by the mandis and all the intermediaries and the middlemen. And rate cards and rate movements is not going to control that. So RBI and the government have to figure out how to control food inflation. Otherwise, even though we don't have a problem in terms of imported inflation, the local food inflation is what is keeping the long-term interest rates very high. The last market which I want to talk about, and which is another commodity market, is the gold market. And gold market is something which many people are, completely, I would say, engrossed by it or absorbed by it because gold has moved so sharply. Now, the reason for that is that globally, a lot of currency is being printed, or a lot of liquidity is being, flushed into the markets. And countries like Indonesia, Philippines, and maybe even India, we are going down the, currency printing route. The central banks are going to print currency and hand it to the government against bonds, just so that the government can spend. So countries are already doing that. The UK is doing that for the short run. That means for less than 1 year purposes. Indonesia, Philippines are already doing that. And we should also be going down the same path, hopefully in the next couple of months. That's the common thing which economists are saying. And whenever that happens, the gold prices react very sharply because investors believe that gold is the alternate currency. And so whenever a lot of currency is being flushed into markets, whenever there's inflation which is feared in the markets, gold prices rise. Now you can notice one very interesting thing. In the period of the lockdown, during April and March and May, this graph is flat. This graph is the MCX gold spot price, rupees per 10 gram, and this is flat because the Mumbai gold markets were closed because of the lockdown. So even though you could purchase gold in other ways, the official price was not getting changed, and so officially gold was stuck at this price, and that's why you can see a very sharp jump towards the end of May and beginning of June when the official price and the unofficial price got together. Now, the peak of gold actually happened somewhere in August and has passed. People continue debating whether or not gold will go up or go down. I personally don't have a clue. The simple reason for that is that if currency debasement doesn't happen in India, if the RBI does not monetize the deficit, as it is technically called, gold prices will suffer. If a vaccine comes and the real economy jumps much more quickly and we have a V-shaped recovery, then all these measures will be eased very quickly. Gold prices might actually come down. So what's going to happen? I don't know. But what I'm very sure of is that whenever there is currency debasement or a lot of currency is printed by the central banks to monetize the deficit of the government, gold prices usually go up. And this is what we also see in this particular slide. Now coming to the steps taken by the regulators, and I'm talking about the regulators first because regulators have the prime responsibility for the markets. Now understand, when we talk about a crisis in markets, it's not just about the direction of prices in the markets, it's about a lack of liquidity, it's about a lack of trust, it's about a lack of uncertainty, right? And so the steps which the regulator has to take has to be not just to push prices up or down, but to soothe the nerves of markets, to make the market participants more comfortable, to ensure that no one takes excessive risk and completely goes bankrupt. And so SEBI very quickly, even before the lockdown came into effect on 20th March itself, it came out with a lot of different steps. So as you can see from the slide, the positions in FNO or futures and option segment of the markets were restricted, right? The cash segment margins, essentially, if I'm going to buy stock, I have to put up more money beforehand, was increased from almost 20% to 40% in certain cases. There was a limit on institutions in terms of what positions they can take in the Nifty futures. And these measures were initially announced only for 1 month. Essentially, the SEBI was telling the market that I am on a wait and watch mode. I am bringing in these measures in March. If by the end of April everything looks fine to me, I will again reverse these measures and allow you to do what you want to do. This is a classic sign of a regulator which is very in tune with the markets and understands what the market and their institutions need and is not behaving as an overbearing regulator but as a supportive regulator. And this was very much appreciated by the markets. And so every month on month, as SEBI has seen the markets continue to need these restrictions, they have been extended, and currently they have been extended till 24th September. SEBI also recognized that because of the pandemic, companies might be getting behind in their payments. There might be companies with good business models, with good cash flows, which have issues in collecting cash and making payments. And so the norms for recognizing which companies have defaulted were eased for credit rating agencies. Essentially, credit rating agencies were told this is a tough time. Don't push companies into default just because they are a day or week late, right? And that too, they were very clear that this is a genuine problem and companies are genuinely in trouble. Again, this lifted a lot of market spirits. There were a lot of measures to facilitate fundraising. Temporary regulatory relaxations were given because the whole regulatory process to raise funds in India is a long process. So there was fast-track processes which were initiated in terms of rights and preferential issues. So you saw that Reliance also went ahead with its rights issue, raised money from other institutions and investors abroad, and many other companies have come up with rights issues and raised money from investors. This is all because SEBI was very, very vigilant, and SEBI understood that I need to support companies in raising funds. Now understand, all this reassures companies that markets will continue to function, right? And markets will continue to support the participants without being overbearing and without excessive control by SEBI. If you look at what SEBI has done in April, it reduced the turnover fees for brokers, it reduced the filing fees for issuers, it eased the process of online KYC for opening a demat account, essentially supporting brokers and other new investors coming into the markets, right? To ensure that uncertainty comes down and investors are well advised, it told companies and came out with regulations that COVID-19 impact has to be specified clearly in their annual reports. And it also issued relaxations on preferential issue pricing for companies with stressed assets, because earlier the rules were that if you have stressed assets, the preferential issue has to be priced with the approval of SEBI, and nobody should get a benefit in that preferential issue pricing. But right now SEBI realizes that promoters might need to pump in capital very quickly, and so some relaxations were also given in terms of the preferential issue pricing to ensure that companies with stressed assets don't suffer and capital flows into such companies. Coming next to the RBI, we have all been seeing the LTRO and TLTRO operations, but very few of us know that even though the LTRO operations were a success, the last TLTRO or the targeted LTRO failed. And let me illustrate what happened. If I look at the LTRO, the long-term repo operations, essentially this happened even before the pandemic was announced. So you can look at it, it was announced in February for an amount of 1 lakh crore. Essentially the RBI told banks that please borrow from me at 5.15%, which is the repo rate, and go and buy government securities. Government securities rates at those point of times were around 6.5%. So if I'm giving you a loan at 5.15 for 3 years, and if you go and buy a government security at 6.5%, automatically you are going to book profits. So this was a golden opportunity for banks. Banks went joyous after this, and everyone benefited from this because government borrowing rates came down. Banks were able to put away excess liquidity in government bonds, and banks were able to make profits which supported their balance sheets. So either I ensure that banks are profitable, or I, as the government and the owner, needs to put up fresh capital for the banks. And so the LTRO was a very interesting and unique step in which RBI ensured that excess liquidity goes to the government, the rates come down, banks become profitable, and capital requirement comes down. What happened in TLTRO was that the initial 2 TLTROs in March, once the lockdown started, were aimed towards companies. Essentially, the RBI told the banks, borrow from me at a reduced rate and buy corporate bonds. And about half of them have to be freshly issued corporate bonds. When RBI realized that all the corporates which benefited from this are the AAA ultra large corporates, essentially the same companies which are there in the Nifty 50, RBI realized that the other companies are suffering. That is when it came out with TLTRO 2. So you can look at this, and it says TLTRO 2 on 17th April, when it realized that all the benefits of TLTRO 1 went to large corporates. TLTRO 2 was designed to go to small corporates and other non-banking financial institutions. Banks simply rejected that. Essentially in TLTRO 2, what happened was that even though the RBI was offering 25,000 crores at a rate of about 4% to the banks for investment in small corporates and NBFCs, banks did not borrow the whole amount, 25,000 crores. Banks only borrowed 12,500 crores. And that is why the RBI did not come out with the rest of the 25,000 crores which was due. So the LTRO for governments was a success. The TLTRO 1 for large corporates was a success. But the TLTRO 2 for small corporates and NBFCs failed miserably. Apart from that, seeing the sharp depreciation in the markets, the RBI executed something known as sell-buy swap for dollars with banks. Essentially, it gave dollars to the banks, and on that day itself, booked a rate at which it will buy back those dollars from the banks 6 months down the line. So when depreciation was very sharp because the foreign institutional money was flowing out of the country, it provided dollars to the banks and ensured that the currency is supported and the banks are supported. And this was also a very positive step taken by the RBI. These are just again some highlights of what the RBI did. As we are running out of time, I'll just very quickly jump through this. As we discussed, trading fell down because the traders in banks and institutions could not trade from home. So essentially, the market hours were truncated from the standard 95 to 10 to 2. It provided a direct refinance to NABARD, SIDBI, NHB, and Exim Bank of 65,000 crore because TLTRO failed. It enhanced the limit at which states could borrow directly from the RBI, which is the ways and means advances limit, to 2 lakh crores. It then engaged in something which is known as Operation Twist. Operation Twist is very interesting. The RBI goes and what it does is it sells short-term bonds and it buys long-term bonds. What that is supposed to do is it's supposed to raise short-term rates and push down long-term rates. So essentially the RBI is trying to twist the yield curve, right? RBI is trying very hard. Nothing much is happening because most investors in the markets are very, very fearful of the inflationary scenario which probably lies ahead. Seeing the issues with mutual funds, especially debt mutual funds, a special window for mutual funds was opened by the RBI, which is again a very unique initiative taken by the RBI. And the last one is that banks were allowed to convert their LTRO funds of 5.15% to the new reduced rate of 4%, thus allowing them even more profits. Because if the banks are not profitable, the banks will start to have capital troubles once the moratorium is lifted and NPS started accumulating in the system. And the last, I just want to very quickly highlight the role of the government. Now, as I've said before, the role of the government is not really in managing markets or soothing markets. The role of the government is more on the ground economy. So that's why a 20 lakh crore COVID package with the government claim was 10% of GDP was unveiled by Prime Minister Shri Modi on 12th May 2020. The government claims it's 10%. Many analysts debate that. They say it's around 1%. That debate will continue. But again, the whole impact was for the real economy and not for the financial markets. Various compliances have been eased by the Ministry of Corporate Affairs. Many minor reforms like Agricultural Market Produce Committee and others have been pushed through because of the COVID. But again, all of that is for the economic support for the real economy and not directly for the financial market. It is hoped that in the medium to long run, the improvement in the underlying economy will also reflect in the financial market. In closing, I just want to say the period of crisis in financial markets was essentially in March. Post-March, markets have started relaxing once they've realized that governments and the regulatory bodies are on the feet. It is not a repeat of 2008-2009 when everybody was caught napping, and all regulators and the government has taken proactive steps to ensure that the financial markets continue functioning, people are able to raise capital, and people are able to invest in the securities which they want to invest. With this, I'll close the session. Thank you for hearing me out. I'm sorry I've gone a little overboard at 53 minutes. I will now take some questions from Prakriti. Yes, Prakriti, please read out the questions for me. I'll reply.
Okay, so we have about 15-20 questions in store with us that
Okay.
I felt were relevant. You can guide me further. Okay,
Yeah.
so one of them is from Mr. Nikhil Dhiman. He says that the first lockdown in India coincided with the $3 trillion package offered by the US government. How much of recovery in Indian markets can we attribute to the recovery of global markets due to that package?
Hi, Nikhil. Hope you're doing well. You have raised a very pertinent question. Essentially, what happened in the US was that they flooded their markets with dollars. In fact, the US Fed went ahead and started buying corporate bonds via ETFs. The US Fed essentially said that we are here to ensure that liquidity continues pumping throughout our economy. And when liquidity pumps in the dollar economy, it flows globally, because dollar is the global currency. And you are completely right. Once the US Fed reacted, it was a signal to every other regulator to also react, because regulators move together. If the US Fed lowers the rate, but the RBI does not lower rate, our currency will depreciate. Because the US Fed lowered rate, the RBI was also forced to lower rates. The whole central banking systems across the world moved together. And so that action very truly helped in the recovery of markets globally, not just India. Prakriti, can you give me the next
Great.
question?
Yes, sir. So the other one we have is from Mr. Rizwan Iqbal Wani. He asks, why has GDP got so down despite Sensex and Nifty is going good?
Hi Rizwan, hope you're doing well. As I said, the disconnect between the real economy and the Nifty 50. The Nifty 50, a significant chunk of Nifty 50 is Reliance and private banks. Most of them are doing well. Most of them have been able to raise capital because of things like TLTRO1. They have gone in for rights issues. They are urban institutions dealing on B2B and B2C on the urban domains in India, and so those institutions are relatively safe. That's why Nifty 50 is doing very well. But you are 100% right. If I look at the broader market, there are still many stocks which are near the lows. If I look at the broader index such as NSE 500, it has not recovered as much as the Nifty 50, and so there is a sharp disconnect because the GDP talks about the whole country, whereas Nifty 50 only talks about these particular few corporates.
Great. So we have one from Dr. Kunjana Malik. She asks, can the crisis see any relation between Indian VIX and the oil prices?
Hello, Dr. Malik. Hope you're doing well. The Indian VIX is more of an indicator which is locally defined by Nifty options trading on the exchange, whereas the oil prices is essentially the Indian crude basket. This is a mix of Dubai crude prices and Brent crude prices, and that is globally defined. So there might not be a direct, two-way relationship between the two. And in fact, what you would also observe is that while crude was coming down, VIX was going up. If you do an econometric analysis, my hunch would be that there might be a bit of causation, grandeur causality as we call it in econometrics, from crude to the VIX and not vice versa, because the India VIX is local whereas crude is global. I hope that answers your question. Can I have the next one, Prakriti?
Yes, we have one from Mr. Tarun Lahoti, sir. He asks a related question on repo rates. Why commercial banks are not reducing lending rates despite lower repo rates?
Hi Tarun, hope you're doing well. See, try going to a bank branch today and getting a home mortgage or a car loan or say a small business loan. The banker will accept your papers, but your loan might not be sanctioned. Every banker today is very worried about what will happen when the moratorium is lifted. How many people are going to come back and pay up the outstanding dues? If people do not pay up the outstanding dues post the moratorium, all these banks will be saddled with a lot of bad loans. This fear of bad loans and the NPA crisis and its expansion in the minds of bankers essentially is, in a way, stopping bankers from extending the loan book. The feeling is that I already have a loan book which is under stress. Why do I want to give fresh loans in this pandemic period, which might actually go bad very, very quickly? So this whole fear that the loans which I give might turn bad, my existing loans already are bad because of the moratorium and I don't know how bad they are. This whole thing has created fear in the minds of bankers. And this is very clearly reflected that banks are keeping 5 lakh crores, that's about 5 trillion rupees with the RBI at reverse repo. Banks are saying we will keep all this money with the RBI, but we will not give this to consumers. Why? Because we are fearful that if we give this out as a loan, defaults will happen. Whereas if we keep this with the RBI, it is relatively safe. Can I have the next one, Prakriti?
Yes, sir. This one comes from Mr. Vaibhav KS. He asks, due to the moratorium, will there be a relief as far as reporting of default to any credit rating agency is concerned?
Hi, Vaibhav. See, regarding moratorium and default, the thing is that once the moratorium is lifted, then you are liable to pay up whatever you owe. A relief might come, some sort of delay might be allowed, but I think that once the moratorium is lifted, all defaults will be reported because that has been the standard process. And a default is a default. See, a moratorium was given to everyone who wanted to take it, and that's why no defaults were reported. But once the payables are due, once the EMIs are due, they have to be paid. Can I have the next one, Prakriti?
Yes, sir. So this one comes from Miss Dikshita Gujarkar. Is the Indian stock market going to crash again?
Hi, Dikshita. See, this is a question which talks about the future as to whether markets are going to crash. Let me ask you another question and think about it. Just put yourself back in the last week of March when the markets had crashed by 40%. At that point of time, if I would have asked you where do you think markets are headed, you would have said markets are going to go down because there is a pandemic, there is a lockdown, there is no economic activity, and markets will crash. What happened since then is that markets have recovered almost all of the losses. And historically, it has been seen that whosoever tries to predict markets gets it right about 50% of the times and gets it wrong about 50% of the times. That's what efficient market hypothesis tells us. That's what a large number of research studies tells us. And so I'm not going to give any indication as to what markets will do down the line because markets can go up even more. I'll not be surprised. And markets can definitely come down given the economic scenario. Can I have the next one, Prakriti?
Okay, sir. So, considering the shortest time, so we'll take one last one. This is from Arvinder Kaur. They ask when banks and financial institutions initiate repo transactions, if it's for 3 to 14 days, then how reverse repo happens for overnight?
Yeah. So essentially, all these transactions are for overnight to 3 days to 14 days. There's a wide variety of these transactions which are there. Now, because banks are very fearful that there might be a rate cut coming at any point of time, they are only keeping money overnight at the reverse repo rate. They're not going in for a longer repo. And even RBI is discouraging them for keeping longer repos. That's why most of the reverse repo is happening overnight. In fact, you can go to the RBI's website and there is a page on money market operations which is updated on a daily basis. That page will tell you how much money has been lent out at the LTR or the LTROs, how much money has been kept at the reverse repo, what is the excess liquidity in the system, and you'll be surprised to know that RBI indicates that system has excess liquidity of 4 lakh crores. This again ties back into the whole idea that if 4 lakh crores is the excess liquidity, why are lending rates not coming down and why are banks not lending? The answer is that the real economy is in fear and it's not related to markets. Regulators have ensured that the markets are calm, the markets are panic free, but the real economy is in deep distress. I hope that answers your question. With this, I would like to close the session. Thank you everyone for joining in, for sparing valuable time and listening to me. I hope I've been able to clear some of the doubts which you might have in your minds regarding how markets have behaved. I hope you now understand that there was a crisis which regulators took care of because they were proactive this time. It's not 2008, 2009. Real economy is in crisis. When will it reflect in the financial market, which we most watch, the stock market? Nobody knows for sure. I hope you keep doing well. Take care. Thank you.
Thank you so much, sir, for this very, very knowledgeable session. I think everybody has been giving you lots of hands up that it was a great session, a fantastic session, a lot of comments on the chat box as well. If we do have more questions that we think are pertinent to the session, we will be more than happy to pass them along to you if you would like to answer them. Over and above that, thanks to all the wonderful attendees who were a part of today's session, who asked such wonderful questions and participated. Just to add, we will be certificating you. Yes, we will be sending out your certificates and your feedback form in a mail very soon to your registered email IDs. Please look out for the email. In case you still feel that you have not received it, you're open to share email back to us at support.india@mheducation.com. Just before I leave, I would really like to highlight another book that is showing on your screens right now, Financial Markets and Institutions, co-authored by our speaker today, Professor Anshul Jain. It will be soon available on Amazon. Please look out for it. It's coming out with its 7th edition in the markets. Thank you so much, everybody, for joining us today, and hope to see you soon. Thank you.